Well, good evening, everyone, and welcome. We've got here is 5 p.m. Pacific, 8 p.m. Eastern. We're going to give it one more minute or so before we dive in to today's presentation. But again, thanks all for joining, and we'll get started here in a minute or so.
So Reid, sound check. Can you hear me okay?
Surely can.
Good. I just had to swap to my headset. I was getting distorted.
Past the hour, I think we should definitely get started here. And for all those people coming in late or later, as people start filtering in, this will be recorded and we will be sending out a recording of this webinar if you guys have to jump early or you join late. So first and foremost, a big hello and welcome back to all our returning investors. It's great to see you all and some very familiar names here in the participation window here in the waitlist. So hello to everyone. For those people who are new to RSN, it's a big hello and a warm welcome from us, and hopefully you'll get a good insight into how we think about investing in today's current economic climate. But this is just a bit of a brief background on this. This is the state of the market. We're talking. This is a follow-up from a webinar series that we did about 6 months ago, when back in November, late of 2022. And this is really the sort of second part of that as we come through sort of really unprecedented times. But before I do get into that, I want to welcome next to me, as always, Ben Gray, my trusty partner and COO here at RSN. So I'm going to hand it over to Ben for a quick introduction.
Oh, great. Thanks, Reid. Well, thanks for joining, guys. I've got a couple of things to get us started. I want to remind everyone that we are genuinely live. So you might hear a dog bark or a baby cry. I've got a little cold, so you might hear me cough or sneeze. You might hear us stumble on our words, but this is the way we like it. If you're giving up your time to meet with us, we don't want to press play on a video. We want to be here, we want to be real, and we want to give you the opportunity to ask us questions at the end that are completely unscripted. So with that, Reid, I think we've got a good number of attendees. We're well into it.
Yep.
Let's get started, huh?
Let's get started. We're going to turn our videos off so you get the full screen for everyone for the recording. But yeah, so as I mentioned earlier, we've had extremely positive reception to our last State of the Market webinar in November last year. And we've decided to do another one. And we think we're going to continue doing these every sort of 6 months as we go through some extremely unprecedented times right now. And the purpose of these webinars is really for us as a company to share our thoughts on the current state of the market, along with how we are responding to many of the challenges that we're seeing in the last 6 to 12 to 18 months, but also to sort of look ahead and see what any opportunities there might be coming down the pike, which we think we're going to be really poised to pounce on. After a brief introduction, we're going to go and jump straight into the same agenda as we did in the last webinar. We're going to start with a bit of a brief recap from our last webinar, and then we're going to move into where we've come from over the past 6 months, where we are right now, and where we're going. So with that being said, I'll also just add, we're going to have a live investor Q&A at the end of this. So with that being said, let's get into it. And before we, if you do have any questions throughout this webinar, as Ben mentioned earlier, we are coming to you live. So please put them in the chat, or you can email it to me at reid@rsnpropertygroup.com. And that will be where we can answer any of your questions. So we're going to spend probably the first 30 to 40 minutes, 30 to 35 minutes doing a presentation, and then we're going to hand it over to live questions for the last 15, 20 minutes. So with that being said, I'm going to give a quick, brief overview of who we are as a company. And again, for those people who have invested with us in the past, a big hello and welcome back, and thank you for joining and supporting us. For those people who are new to RSN, just a brief background. We've been in operation since 2014, and over that time, we've had a portfolio in excess of over $700 million to date. We're a bit shy of 4,000 units in the portfolio at any one time. And that's about 23 syndications, I think, in that time. And we, really focused on looking to grow investors' capital by buying, strong performing assets in growing MSAs throughout the United States. And we really target project level IRRs between 16 and 17%, netting a solid return to investors of between 1.7 to doubling their money over a 3 to 7 year hold. We're really into renovating and rebranding and repositioning assets, and we really think that our thesis in where we are at RSN is buying affordable, quote unquote, affordable housing, and looking at that sort of class B space, B plus space, and really catering to those folks who earn between $40,000 to $80,000 a year in emerging markets across the United States. We're currently in Central Texas, San Antonio, Austin, Phoenix, Arizona, some parts of Georgia, and we've just broken into Greenville, South Carolina as well, and looking to continue to expand. So with that being said, we're going to quickly touch on our team here. We want to talk a little bit about a team, but it's just Ben and I on the call tonight. It's the two founding partners here at RSN. We also have Austin DeGue on the call and Josh Oaten. They're only part of our wider team, and I'm sure most of you have dealt with our team and who we've got involved here at RSN. But with that being said, we're going to get into it. And Ben, I'm going to let you do a little bit of a recap of what we've done since our previous webinar.
Fantastic. Thanks, Reid. Well, look, in our last webinar, we covered a lot of ground. And one of the key points that we made is that it's going to be a rough road ahead for investors in the economy. So we're at the tail end of the longest economic expansion in the history of the United States, even if you consider the very brief recession at the start of COVID. And that's what this chart on the top left indicates. The white areas indicate periods of growth and the gray areas represent recessions. So because of all of this, in the last 10 years, it's been very easy for investors in all asset classes, including real estate investors of all skill and competency levels, to make money. But timing does not equal talent, and the next 10 years are not going to be like the last 10 years. We anticipate a lot of investor and operator heartache over the next year or two. The silver lining is that we staunchly believe that for savvy, prepared investors, this will be a great time to invest. There's going to be a lot of opportunity. And we touched on a number of challenges back in November of 2022. Inflation was at the highest rate since the 1980s, and it was the quickest increase in inflation in modern history too. Interest rates, the Fed funds rate climbed from 0% to 3.75 to 4%. And today it's actually at 5 to 5.25%. And this was the quickest increase in interest rates in modern history. And this impacted the multifamily investing landscape in a few key ways. Multifamily assets are priced by the cash flow that they produce, and the assets in the marketplace weren't being repriced for the new rates. Sellers didn't want to change their prices, and buyers didn't want to pay prices that they thought weren't fair. So because of this, the market went into a deep freeze and very few deals were getting done. We also talked about another impact, which was that syndicators and investors with variable rates on their projects, and the same common thread was true, because rates rose quicker than they ever have before, they weren't able to implement their value add business plan of renovating the units to increase rents, and thus that was impacting cash flow and impacting investor distributions. And we called out the elephant in the room at the time, which was, look, a recession is coming, guys, and we still think that's happening, and we're going to talk about that a little later. And then we moved on to talking about the RSN response to all of this. We focused on three key things. Number one, the fundamentals behind the real estate market that on a long-term horizon remain largely unchanged. We talked about the RSN investment thesis, how we built it to perform in good times and in bad. And then we talked about how our strategy at RSN has evolved and what investors should expect from us in the future to capitalize on the opportunities that will exist moving forward. The overall theme that we tried to get across is that amidst this market volatility, we see a lot of opportunity, which moves us forward in the presentation to where have we come from? So what happened in the last 6 months since we did this presentation? Well, interest rates are still rising, but at a much more predictable and a much more manageable pace. This has brought relative stability to the industry compared to 6 months ago, and it's helped to begin to defrost the multifamily market, and more to come on that in the future from Reid. And the Fed's actions to cool inflation by hiking interest rates appear to be working. Inflation has indeed cooled. Now, it peaked in June of last year, and that 4.9 print for April is actually today. So, well done to the Fed. Congratulations, job well done. Take a victory lap. Oh, whoops, they caused a banking crisis in the process. So, I make that little joke, but I actually don't criticize the Fed. The US economy is incredibly complicated. You twist a knob in one direction, something breaks somewhere else. It's unfortunately just the way things are. And we have a banking crisis, and we've had some bank collapses. So we've seen SVB, Signature Bank, First Republic, and Silvergate collapse. These are all regional banks. This is mainly impacting regional banks. And how interest rates played into this is that a lot of these banks were invested heavily in treasuries that dropped in value dramatically when these interest rates rose. And it appeared on paper that their balance sheets, had dropped in value, which they had. If they held the bonds to maturity, they would have got the same amount of money no matter what. But when they had to reprice these bonds, these treasuries, their balance sheet took a big hit. And this caused a general fear in depositors, thinking that, their money wasn't safe. So they moved their money to safer banks. And this reduced the assets that the regional banks had on their balance sheet even further. So in response to this, a lot of the banks actually had to borrow money from the government to stay healthy, causing their liabilities to go up. So it's a huge oversimplification, but because of all of this and more, these banks collapsed. And what many people don't realize is that regional banks are responsible for 80% of commercial real estate loans in this country. So couple that with the fact that there's a lot of pressure on commercial real estate right now, particularly offices and retail, and these banks' commercial loans are now worth less again too. So this all plays into the challenges that we see in the market, and it's a good segue to Reid, who's going to be covering the Where Are We Now section of this presentation.
Yeah, thanks, Ben. Great recap on what's happened over the past 6 months. What I'm going to dive into now is what we at RSN are seeing as we chat to brokers, as we chat to you guys as investors, and as we chat to industry insiders, and as also as we go to major conferences like NMHC, which is earlier this year, and talking to people out there in the industry doing deals right now. So all of what Ben is describing is spilling over into the commercial real estate market, and is obviously spilling over into specifically multifamily as an asset class. And I'm sure a lot of you as investors are involved in other multifamily deals, and I'm sure some of you, those deals are experiencing some level of distress right now. And I'm not going to talk about the distress in multifamily sector. I'll do that in just 1 second. But first, I want to talk probably more in general about where we are today, and firstly cover like the economic pessimism that we're seeing. So we are seeing that there is widespread economic pessimism across the United States. And on this current slide, you can see that some feedback that was quoted from CNBC All America Economic Survey, which started, over 17 years ago. And according to this survey, this recent data is actually the worst sentiment they have seen from surveyors in the history. And we can see that 7 out of 10 Americans have a negative view on the US economy. 2/3 say inflation is outpacing their wages. Only 24% of people are saying that now is a good time to invest in stocks. 50% say that their own financial situation is worse than it was a year ago. So overall, this sentiment is that individual investors are really taking a wait and see approach for further investments of all kinds. And that includes stock market investing and real estate investing, because they think that there's more pain to be felt, and thus they want to be defensive with their money in staying on the sidelines. According to another published survey by Alliance Life Insurance Company of North America, out of more than 1,000 investors surveyed, 63% of them said that they're keeping their money out of the market, while another 62% of them said that they would prefer to leave it in cash and leave it on the sideline. Now, the problem that we see with that is that this approach, even though treasuries are paying and CDs are paying somewhere between 4 and 5%, inflation is still at that same rate. So you're having effectively a net zero return on your money in those types of investments. The funny thing that we are seeing is that, there's an old saying in this industry that individual investors during these times, the sentiment is that the investment industry is the only industry in the world where everything is on sale. Nobody wants to buy it, but as soon as it all gets to its highest prices, no one can resist buying more of it. So we are actually seeing a lot of investor sentiment staying on the retail side on the sidelines. Now, because of this, we are seeing on the opposite side of the coin, bigger institutional investors are are not only continuing to invest heavily in the industry today, but they're actually ramping up very, very quickly. And Blackstone just finished their raise on their latest addition to the sector's most recognizable opportunistic real estate fund, which is called the Blackstone Real Estate Partners Fund. And they plan, to opportunistically deploy this money from this fund into certain commercial real estate sectors that they believe that will continue to perform over the next few years. And that includes multifamily. Multifamily real estate housing is one of the things that they're going to continue to invest in. They're also going to invest in logistics. They're also going to invest in lab and offices and data centers. But they obviously will be deliberately shifting away their focus from some of those struggling commercial real estate classes like office and retail. Now, it is generally the larger institutional investors and high net worth individuals who invest in these funds. They're sort of sophisticated investors who we here at RSN refer to as the smart money. And the smart money, went big. They are throwing $30 billion at this fund, making it the largest real estate drawdown fund ever raised. And we do like to say here at RSN that we do like to follow that smart money. And this is like one of the many supporting factors behind our view that we think multifamily will continue to be a great asset class to invest in the medium to long term. Now, with all of that being said, the reason this fund has been so successful in attracting investors is that there has absolutely been a lot of pressure in the commercial real estate market right now. That's the elephant in the room. We all know that. This is particularly prevalent in office and in retail sectors. Obviously, COVID had a massive and rapid changed trends in terms of remote working. It reduced the need for expensive office spaces and businesses cut back on that. COVID also accelerated trends of how people shop online, with obviously online sales seeing a massive uptick and malls and strip malls, no one's going to them anymore. Now, as we touched on previously, the banking sector and the commercial real estate are heavily intertwined, particularly as Ben mentioned earlier, regional banks issue 80% of America's commercial real estate loans. And we see the banking crisis and the challenges in the commercial real estate sector feeding off each other. The end result will obviously impact not only office and retail, but it's going to impact all commercial real estate asset classes. And we see it unfolding in a number of ways. First and foremost, I think we're going to see it unfolding with tighter lending across, all commercial real estate asset classes, potentially even a credit crunch, so to speak. Haven't seen that played out yet, but we may see that coming. We will see refinances harder to obtain obviously in a higher interest rate environment, particularly impacting deals that are relying on refis to get a return to investors. You might also see rate caps, continuing to be extremely expensive, and lenders are now starting to force some operators to siphon cash flow into escrow for, future rate caps to buy them down if they're expiring within the next 6 months. We're also seeing there's a potential that to prop up their own liquidity, we may see some banks looking for excuses to call loans due early. And frankly, this is a big risk that not a lot of people are talking about, and we think could be a very much big potential with the continued banking crisis. Now keep in mind that often banks will bundle office or commercial real estate loans together, but in particular they do bundle office and multifamily loans together. So if a bank needs to call a loan due to prop up their own liquidity, they'll prefer to liquidate one of those that doesn't cause them to take a huge loss on their balance sheet, and that probably will be a multifamily loan. Now, the response we are seeing to these challenges within this traditional lending space is that we're seeing some non-bank lenders starting to pop up and fill that void left by reduced bank financing. Private money lending, pref equity is starting to really, really come back in a strong way. And it comes, obviously with higher interest rates, but it's higher than bank loans, but it still means that people can get loans, deals done in today's market, even in a very rapidly increasing interest rate environment. Now, outside of the banking crisis, there's some other massive factors that are going on right now in commercial real estate. Obviously, the interest rates themselves, right, increasing over 500 basis points in a 15-month period. And we're going to not be apologized for beating a dead horse here, but we all know that commercial real estate values and cash flows are highly sensitive to these rates. With debt service costs going up so dramatically, some deals and some operators are starting to struggle to keep up with these payments. And they're at risk of defaulting on these loans, or have the lender preemptively call these loans due, even if they're not in a technical default. We're seeing big groups like Brookfield defaulting on their office portfolio here in downtown Los Angeles, which is sending big ripples through other parts of the commercial real estate industry. Rates are hitting multifamily operators too. You might have seen in the news that 3,200 unit portfolio in Houston, it just had its loan call due. Now this particular operator wasn't a massive operator. I think you're a relatively new operator. I do know that I think he was part of a coaching group that this coach was parading him around on stage for all of his success. And I don't know all the details of how the property is performing, but what I do know is, the lender involved in this particular deal is notorious for being a loan-to-own lender, and we at RSN actually avoid this lender at all costs, given their reputation, but to be unnamed. But whatever the situation on this particular case, we feel comfortable stating that across the industry, inexperienced operators will be found wanting over the next 12 to 18 months. And we're also quickly seeing, as I mentioned earlier, with places like Brookfield, bigger shops, that it's not just going to be these newbie operators. They're going to be some well-known operators who are going to start having struggling deals too. And we're hearing that murmurs in, as we're chatting to different brokers in different, events that we're attending. And a lot of these projects, have floating rate debt on them, and they haven't defaulted on this debt yet, but they are starting to see signs of trouble. And the reason of this struggle is that the cost of this debt has increased, faster than the implementation of anyone's business plan. And this is not just to one particular asset class or one particular market. It's across the country. And if you combine this with cooling rents across the US and say expiring rate caps, forcing operators to escrow money for future rate caps, so it's resulted in operators having to do capital calls, because in order to buy that new rate cap or be forced to do a cash-in refi, when these with these non-traditional bank lenders, as we mentioned earlier. We're also seeing some sellers with expiring debt, just willing to exit their investment as they don't want to refi in today's higher interest rate environment. Now, separately to these interest rates, where deals are also struggling due to increased insurance costs. We're seeing, the recent environmental events over the past few years really starting to impact renewal rates across the country. We're seeing rates in Texas and Florida jump as much as 40 to 60% on premiums. Historically, on a multifamily asset, you could probably have underwritten to a $400 to $500 per unit per year for insurance back before COVID. Today, you need to be underwriting to at least $800 to maybe $1,200 per unit in Texas, and probably even more in a state like Florida. Now, some of our deals in some of our markets, like Phoenix and the Carolinas, we're still seeing low sub $500 per unit per year on premiums. But we do know that these effects from Texas and Florida will start permeating around the country, and sure enough, it will probably start impacting our markets too. Now, I'd like to speak to the deal flow and transition to what we're actually seeing in the markets in terms of real-time data. We are seeing, Ben, we got the next slide up there?
No, you're actually still good, Reid. So go ahead and I'll get you in a sec.
Sorry. My computer must have frozen. But in terms of what we're seeing in today's markets and real-time data, we are seeing purchase cap rates that have expanded as much as 150 basis points across some of our target markets. Now, market cap rates is a measure of what people are willing to pay for certain assets, and are linked. These market cap rates are linked directly to the Fed rate, right? So, example of this is, a year ago, in a market like, say, Phoenix, you could be buying value add 1970s, 1980s assets for probably, low 4 caps. Today, we are picking up assets in the mid 5 cap range. We just picked up an asset in Tempe at a 5.4 cap. Which is remarkable expansion of cap rates, and other markets like Central Texas, we have seen that particular area seem to hold off in terms of price adjustments. They for some reason they're still hanging on to the mid to upper 4 caps on their purchase price adjusted for taxes. However, we are starting to see that adjust in real time, and there's actually a case in point. I was on a deal in what's called Stone Archer Canyon in San Antonio. And that particular deal, we had a whisper from the broker saying about $38 to $39 million. I was underwriting it to my underwriting standards, and we we're coming in at $35 million because we just needed a true 5 cap on year one, adjusted for taxes. I called the broker. I said, hey, mate, we're nowhere near that 38 to 39 million. I'm just not going to submit. Lo and behold, he said, no, I think if you submit at 35 million, you're going to be competitive. Well, I actually got into best and final. I ended up losing out to another group who was willing to pay 36 million, but we're slowly starting to see even Central Texas start to adjust into the low to mid 5 caps. Now, with this expansion in cap rates, and multifamily sales are down 74% year on year. And this is the lowest since 2008 or 2009. And this slowdown in activity is really, what we believe is linked to the fact that valuations of multifamily assets have just frankly dropped in the last 12 months. And some sellers have adjusted their prices because they're still in the money and they can just still get out and make a profit and make their people, make their investors money back. But some, are stubbornly refusing to sell, and many more are just simply not even listing their properties while they wait for the interest rates to drop and hopefully values to pick back up again. The most viable deals we're actually seeing on the market today is a combination of sellers with that expiring debt, or sellers with great in-place debt terms, say sub 4% interest rate with still 5 or 6 years left on their loan, looking to sell it at a sub 5 cap going in because they have such good in-place debt. So we're seeing a combination of the two. Now, the positive side of all this is that the deep freeze in the multifamily market, which we have experienced for the past 12 months, is starting to thaw. And we believe it will continue to thaw if the Fed truly is going to start pausing interest rates. We are starting to see a few more deals hit the market as the start of Q2 when we compare it to the start of Q1. We're still way off what we believe the volume should be if you compare it to years gone by, but it is a promising sign that we'll hopefully start to be able to offer on a higher number of attractive looking multifamily investment opportunities later this year. Now, we have continued to underwrite properties. We've continued to tour deals. We continue to turn over rocks because we want to keep a pulse on the market in real time. And just like that Stone Archer Canyon deal, well, I was able to determine what cap rates are starting to adjust to in real time. You may not have actually seen that deal hit the market in terms of what it sold for until it actually goes through a transaction. Well, because I was in best and final, we could see that. And we're doing that across many, many different markets. And that's the most important thing, is that we have to continue to use the exact same underwriting standards as we always have, stick to our guns. Now, this might mean that we are probably going to do fewer deals this year than we would like to, but we are positively optimistic that the second half of 2023 will have more deals to hit the market and hopefully more of those gems to find out. So in addition to the market thawing, the silver lining here is that all these headwinds is that the interest rates have probably peaked and are projected to steadily probably drop over the next few years. Firstly, I'll say that as of last week, we all know that the Fed increased rates by 25 basis points. And they did indicate, Mr. J. Money Powell did indicate that this could be the last rise before potentially pausing or even cutting. Now, inflation is persisting to be above 2% target, and jobs data is unexpectedly strong as of April. But in the face of this banking crisis, it seems unlikely that we're going to keep raising rates for the foreseeable future. And as you can see here, it's supported by this dot plot, and each of these dots on this plot represents the opinion of one of the 7 members of the board of governors of the Federal Reserve System and the presidents of 12 reserve banks. So you can see the highest ranking Fed officials themselves see rates trending down to 2.5% over the next couple of years. Now, if that last rate hike last week is in fact the final one before a pause, history will show that it takes on average about 8.5 months before the Fed will start cutting rates, which will put us, if you do the math, in early 2024. Now, we've been talking a lot about the looming recession on our last webinar, and we still stand by this call. We are going to see it hit in 2023, depending on the data sources that you subscribe to. Some data is around 80%. We are actually preparing for it as if it's 100%. And you'll notice from this chart that as soon as we hit a recession, the Fed is usually forced to cut rates. So the timing of this recession will impact when we see rates cut and how deeply and how quickly they will cut. So with that being said, let that all sink in for a little bit, because I do want to transition and let's talk about what some of the opportunity that's coming down the road. And we think that opportunity for strong firms like strong investors and strong firms like us, we will be there, ready to ready to pounce. We have covered a lot of doom and gloom head on here, and we've called a spade. And some of you might be actually feeling a little scared, and rightly so. However, that's why you join these webinars. You don't want to, stick your head in the sand. You want to keep up to date on the market and hopefully be able to see past the fear to the opportunity. That said, we realize that we've given a lot for you to process here, and all things considered, it's a complicated and rocky road ahead for the economy. Also, the real estate market and multifamily specifically. We will see some operators, won't be able to navigate this road successfully. And we're going to see an uptick in deals collapsing and potentially even operators collapsing themselves. Here at RSN, we're relatively a small and nimble operator. Our core business is financially strong. We have a good track record that lenders love, and we pride ourselves on having a well-established reputation in the industry for doing what we like to think is good business. But all in all, very strong position to swoop in and acquire these deals at what we think are going to be discounted prices coming up here in the next 6 to 12 months. With that being said, we want to talk about how we are positioning ourselves moving forward. And as I mentioned earlier, the fundamentals of multifamily real estate still exist today. And we said it on the last webinar. We'll say it again today. Affordable housing is what is needed. People need shelter here in the United States, and it's only been exacerbated by inflation, a high inflationary environment. We are seeing newer build products either being paused or put on the shelf because you can't build or it just doesn't pencil in a high interest rate environment, and thus putting more pressure on the supply and demand curve, right? So we still think that affordability, people who need shelter, people who earn between $40,000 and $80,000 a year need somewhere to live. We're also, the affordability is encouraging people to rent. So people who can't, were saving up for that first time home may not be able to go out now in a 6 or 7% interest rate environment and buy that first time home. So they're having to rent for longer, which is going to be good for the fundamentals of real estate overall. Next slide. Thanks, Ben. And we're still continuing to, obviously buy in landlord-friendly states. We're still continuing to buy workforce housing, and I mentioned between the $40,000 and $80,000 a year. We still love in multifamily from how it tracks in inflation. We're obviously signing 12-month leases. We can, renew leases every 12 months and keep in line with inflation if it continues to be a problem. And we think multifamily, gives us a good, strong position out of the gate for a medium to long-term investment. And that, that goes to our thesis and how we're adjusting moving forward is that we are focused on equity growth. We still are focused on cash flow, but we're focused on better quality assets and better located areas. We're also looking to have larger cash buffers, so over-raise some money at the beginning to make sure we can ride out any downturn. We're looking to try and have flexible hold periods with our, particular investments. And we're also looking for tax advantage deals. For those people who are on this call that might be invested in our Greenville deal, we actually just got our tax abatement the other day. We got a big fat zero on our tax bill for the next 12 months. So we will, by keeping some of our units affordable, and that's on existing deals. So, there's other ways out there to skin the cat, and we are looking for those opportunities in and around the value add space. We're also focusing on off-market deal sourcing. We've brought some of that in-house ourselves, and we're starting to see some fruits of our labor starting to come to fruition, and is starting to execute on and talk directly with distressed buyers. And in terms of how we're moving forward next slide there, we are still focusing on right now fixed rate debt. We do mention that we think interest rates are coming down, but for right now, we do think that locking in debt for the short to medium term with flexible options to refinance in 2, 3, 4 years is the best use for, is the most positive for investors. We're also looking at reducing our leverage. So, not getting leverage on the CapEx, raising CapEx dollars from equity. I mentioned potential refis, making sure that we have that up our sleeve. If we executed on the last 2 deals in the last 6 months, it's all been agency product with an option to execute a supplemental loan in 2 to 3 years. We haven't underwritten to that, but we're continuing to keep those aces up our sleeve whilst also keeping our leverage low and whilst also locking in interest rates. We're also looking at those assumable debts. And I mentioned earlier the Stone Archer Canyon deal in San Antonio, that was an assumable debt at 4.3% interest rate. So we are keeping our finger on the pulse as we move forward into sort of uncharted territory. And I think that is the message that we want to, there's going to be opportunities coming down the road. So with that being said, we're still holding firm on our underwriting standards. I mentioned the example before of where brokers wanted to try and push us to, but where the numbers were staying and sticking to our numbers. And lo and behold, look where we're investing in final. We're also exploring new other investment opportunities. Some of you might have seen our latest investment opportunity, the St. Marcus deal. We're doing a 66 build for rent unit community in St. Marcus, just south of Austin. Actually, a bit of a plug for that deal. We're doing an investment webinar for that deal next week. I've actually had that land under contract with a seller carryback finance for the last 12 months, enabling me to go out and figure out with the city exactly what we need to build. And by right, this asset or this site can actually have 120 units, but we're building 66 build for rent because that's what the city wants. And there's a really easy path forward to permitting and construction. We're also looking at potentially doing a pref equity fund for investors or even a debt fund. So, keep your eyes peeled for that if coming down the line here with RSN. But all of it is, to really be highly opportunistic. We think that there's going to be great opportunities to buy great deals at good discounts right now, with positive arbitrage going in, meaning that the cap rate is higher on the going in versus what you can get interest rates at. And we think that is only good for investors. We're also enhancing our own capital raising abilities at RSN. We're actually hiring a head of sales to come in to nurture, relationships with people like you, our investors. And we actually, one of the things we're going to ask after this webinar is we would love to get real-time feedback from you guys about what you guys are doing. So we're going to send out a survey after this webinar. We'd love to hear if investing. If you are investing, where are you investing it? Because that helps us keep our finger on the pulse where when we go out and hunt for deals, we want to be sure that we can tie up deals and have the equity there ready to deploy. Obviously, you guys as investors, who support us, we can only do so much if you guys are willing and ready to invest in today's market. And some of you may not be, and that's okay, but we'd love to get that feedback. So keep your eyes peeled for an investor feedback coming up here, very, very soon after this webinar. With that being said, Ben, in conclusion, do you want to wrap her up here?
Yeah, look, so Reed's going to actually take some time to gather the questions up and figure out how we're going to tackle those. And, look, like you've seen from this webinar, we're not shying away from, sharing the bad news, sharing the good news, and taking this stuff head on. What I would say is, it can be a little scary. We're actually, from the point of view of, making a good return and doing good deals, really excited. We genuinely think there's a lot of opportunity here. A lot of people made their fortunes in the last downturn, and economic volatility in the market. We're poised to capitalize on that. So we're actually really excited from that point of view. And I'll pause there. Reed, how are you going with those questions? You got a couple that we want to tackle?
Yeah, got a couple of. So firstly and foremost, there will be a recording of this being sent out. So for people who had to jump off, a recording will go out. So so we've got a couple of questions here. Ben, we can start with, let's have a look here. Debt ceiling. Any comments on the debt ceiling right now?
Yeah, well, we've been talking about that one. So, okay. Look, I mean, the debt ceiling is, as far as I'm concerned personally, it's largely political theater, insofar as I think in the last 50 or 60 years, the debt ceiling's been raised 70 times. Every time this negotiation comes up, it gets blasted in the news, and the outcome is always that the debt ceiling gets raised. So, I track it a little bit, but I don't see it as a serious threat. There have been scenarios where the debt ceiling hasn't been raised for a period of time, and government contract workers and other people don't get paid or don't work. But in the reality, politicians, whatever your political leanings, they're not going to let America completely collapse over the debt ceiling issue. So it's something to be aware of, but it's not something that genuinely impacts, at least our investments and what we're doing in any meaningful way, as far as I'm concerned.
Yep. I got a question here about job growth and declining labor participation for an upcoming recession. How this will impact tenants' ability to pay rent and handle any rental increases. A lot in there. Let's start by talking a little bit about, just in general, the rate in which we're adding jobs to the US economy. I think if you take a bigger, we are continuing to add quote unquote jobs. I think, was it February or March's numbers were revised down collectively by 170,000 jobs, not per month, but collectively across the 2 months. If you look at the Q1 for 2023 versus 2022 and 2021, albeit 2021 was coming out of COVID, I think, back in 2021, there was, 600,000 jobs added per month in Q1. I think it was, don't quote me on this, 400 or 500,000 in Q2 of 2022. We're down to, on average, I think 210,000 per month in the first quarter. So we are seeing jobs added slowly over the since the COVID pandemic. And we think that's going to continue, right? Obviously, Jay Powell was saying that he said from the beginning that it would take 12 to 18 months for these high interest rates to work its way through the system, and I think we're seeing that the data happening in real time. For whatever you think about the recent jobs data, it is slowing down, which is I'm not an economist, but we're also seeing less labor participation rate compared to pre-COVID. But all in all, back to the question of how it's going to impact our renters. Well, our renters are blue collar renters, right? I'll be lying by saying, but those folks will get impacted first. So we are still continuing to file for evictions. We're still continuing to work with our tenants on making sure they're paying breeding sort of an on-site what's the word I'm looking for? My mind's going blank. Making sure they're paying on time, and it's expected of them, right? And people who don't want to pay on time, we're evicting, and we're still, that's why we're investing still in landlord-friendly states, because we still want to have that power to be able to get tenants out if they're not being able to pay on time. We understand that sometimes it's not always their fault, but we're also running a business as well. So having tight tenant screenings, rent collections, making sure we're following on evictions and getting people people who want to pay rent in our properties. So hopefully that answers that one. Another one here, Ben, is why is RSN poised to pounce on opportunities compared to other operators? Wouldn't all operators have the same opportunities?
Yeah, okay. I could take this a few different ways, but I guess let's talk about RSN first. So, we're a small boutique operation. We're deliberately remote. I'm in Brooklyn, Reed's in New York. We've got people on the ground in our key markets, but we don't have a huge overhead. We don't have a huge office space. We don't have huge insurance costs. We use a lot of technology behind the scenes. I've spent 20 or 30 years in the technology industry, so a huge amount of what we do is automated, so we don't have to use human resources to do that. Long story short, our costs are remarkably low for a business that does the volume of what we do, and that's just not the same for our competitors. They've got a lot more staff. A lot of them have offices. So long story short, a lot of these other companies have been forced to do deals during this downturn that maybe aren't at the right prices. So they have to overpay to bring in fees to be able to keep the doors running, things like that. So that's one of the big reasons I'd say that we're different. And more than that, we're small and nimble. So we don't have what would you call it, equity partners. We don't have a parent company. If we need to make decisions, we can make decisions quickly, we can move quickly, we can get stuff done. We've got a good reputation in the marketplace. There's just a lot of reasons, I think, why us, rather than bigger, slower companies, have the opportunity to pounce on these deals. So, I could go on about that for a long time. So if anyone has follow-up questions about that, please jump in, but I'll pause there before I take up the rest of this meeting.
Yep. I'm moving now to the chat. We've got a lot of awesome comments here in the chat. Thank you so much for everyone participating, particularly Alex. or exemplar capitalist. One of the questions in and around the difference between cap rates and interest rates. Okay, so value-add multifamily or value-add commercial real estate, you're adding value, right? So you're going in cap rate, probably historically on most deals have been less than your interest rate, right? So let's just take an example. Your interest rate might be 5, but you're buying deals at 4% cap rate because you believe that you're going to spend $20,000 a door and you'll be able to get that cash flow up, and you'll come, you pop your head up, and out of the water and be cash flow positive and be able to distribute money. What has happened in recent times with how quickly interest rates have gone up, those 4-cap market deals, the interest rates might be now 6.5%, 7%. Rule of thumb I have seen over the last 8 or 9 years doing this, if you're within 50 to 75 basis points, sort of, historically, I'm talking about pre the raise in interest rates, where markets have been a bit more less volatile. If you've been going in with a negative arbitrage of your cap rate being less than your interest rate, you could probably handle 50 to 75 basis point spread, right? If you truly believe that you can increase rents $300-400 a month, and you're believing in that. Today, I think what we are finding is that the last 2 deals we have purchased, one we just closed on the end of March, we bought the interest rate down to about a 5% interest rate, but we bought the deal at nearly a 5.5 cap. So we're going in with positive arbitrage. There's still a value add component there, but instead of being negative cash flow from day one, we're positive cash flow from day one. And we're seeing more of that happen in real time. The question around, I think Alex was answering about, having cash reserves on hand. Well, if you look back at historical deals, a lot of operators would over-raise and, with that negative arbitrage and be, supplement year one cash flows until they got the deal, they added that value and got it to where, coming up for air and positive cash flow. But when interest rates now have increased so much, it's extremely hard to do that. You can't implement your business plan quick enough to keep in line your NOI growth in line with how much interest rates have expanded. But on the converse side, I now have seen deals start to transact, i.e. we just bought a deal, value add deal, and it's been positive arbitrage. I haven't seen positive arbitrage deals on value adds probably since 2015, 2016, but we are starting to see that come back around. And we are focusing on that. So back to the question on underwriting standards, we want to see, not only what we want to see cap rates in and around the mid fives, we also want to try and get interest rates, either buy the interest rate down or get interest rates at par or positive arbitrage, so we have cash flow from day one. And we think that's extremely safe position to be in, particularly when you have low leverage debt, around 60 to 65%. And then you're doing other things like raising equity for your CapEx, raising CapEx money from equity, right? That means that you've got a massive reserve sitting on. And if things get more rocky or your business plan doesn't go to plan, you can pause on that. You're not beholden to the bank to deploy that capital and have to do those renovations if you're not getting the rent pops. So I've said a lot of things there. Hopefully that answers that question about how we're looking in and around looking for deals today, positive arbitrage, and around trying to keep good cash reserves on hand. Serge has asked here, can you talk about RSN's underwriting in terms of cash reserves in each of your deals and the circumstances you would increase the probability of suspending distributions or worse capital calls in the next 2 to 3 years? So every deal is different, right? Capital cash reserves, some percent, and I think Alex has done a good job of answering it here. As a percentage of, potentially of your payments, maybe it's 6 months worth of interest payments, $500,000-600,000. It might be more. It depends on the deal, right? So it's a very open-ended question. Typically, I'm looking for probably around if you're doing, say, I don't know, a $30 million deal, you're probably looking at 3 to 5% of cash reserves just as a cash fund buffer. You may also have on top of that, CapEx dollars that you're, for example, you may say, okay, you may have a lender that says, I want to fund all your CapEx. Well, historically, we have not done that. We've said, no, thanks a lot for that. We'll just take 75% of the CapEx. We've still, and this is, going back pre interest rates, but we've still had some cash to get our own capital reserve, CapEx dollars or work started. And that's been, again, added to the kitty of reserves. Today, we are not doing any leverage on the CapEx and raising it all from equity. It does reduce your overall IRR, but it means, again, we're in control of that. So really depends on the situation. As it relates to your distribution question, again, it's all deal dependent. You obviously want to be distributing distributable cash from your deal. Your deal should be cash flowing. If it's not, you probably should be stopping, pausing distributions. And sometimes a pause in distributions doesn't mean that the deal's going bad. It's just that they're trying to preserve cash, and it's the best thing for the deal. Now, in terms of the other question, that you talk about cash in refis, I think that was the other question. It depends on where other factors are coming in. So there's other factors might be, how's your expiring rate cap? Is your lender requiring you to escrow more money for a future rate cap? Do you have to refi in the next 6 months? All these things are going to force you down a conversation with, well, how much money do I have on hand, and how much do I need to go get if I want to hold the deal and not lose investors' money? So, Serge, I don't know if that's answered your question, but there's a lot of, you can spend probably an hour talking about the different ins and outs of that specific question and different circumstances, but it is really dependent on deal by deal. Rate cap expiration, how much cash you got on hand, when you got to refi, how much, time do you have? And, the old saying we're hearing a lot in different conferences is survive to 25. So yeah, hopefully that answers that question. Continuing on, thank you, Christina, for your support. We love you, and hopefully get out to the Pasadena Phoebe sometime soon. I got here from, looks like Nick Hill. What are your tax efficiencies in the investment structure, depreciation? Well, like any physical asset, we are investing in these assets because the difference between that and paper investing is because we get to use depreciation. So depreciation is the number one thing that we like to deploy, particularly accelerated depreciation. And we like to do cost segregation studies that flow through directly to investors. So you can offset any distributions that you receive from an investment in years 1, 2, and 3. You can offset that income with losses, and thus hopefully our target always is the losses from depreciation and business loss is greater than what we distribute to you. Thus, you don't have to pay taxes on those distributions. Now, I'll have to say I'm not a CPA, but that's the goal in which we like to how we like to use depreciation and losses in our deals. What's your funding profile, average tenure, fixed versus floating average rate? So, yep, a lot of things there. Funding profile, we are typically buying deals between $20 and $30 million, and that's because we are confident in raising, equity from $7 to $12 million equity checks. We've done bigger deals in the past, but given investor sentiment right now, I think that is, and hence why we want to get investor feedback from you guys. We are doing slightly smaller deals. Last year we closed on 2 $35 million deals. We just closed on a $20 million deal, and it was one of the hardest raises we've done to date out of 23 syndications. So we're just focusing on what we can. We're biting off what we can chew. We're not trying to go off and do $40, $50 million deals because we just don't have the equity partners to go do that. Now, should our survey come back and say that all our investors are like, let's go, well, maybe we'll change our tune. In terms of we look to 3 to 5 year holds. Historically we have done floating rate debt, pre-COVID. Today we're only doing fixed rate. I think the average rate is what the question here is. We're trying to get interest rates as low as possible. So,
there's a good question from Christina that kind of dovetails into that. I can take first swing at it, and then
sure.
I'm going to channel actually my inner Austin Degu, who's on our team here when I answer this, because it says, can you guess if the Fed has really done raising rates? In the 80s, when they were trying to slow hyperinflation, they raised rates twice. It means to me as an investor, there's a chance that would occur again. What are your thoughts? Has there been enough damage to the economy? Again, channeling Austin, because I think he wrote an article about this, and I'm going to try to remember exactly how he worded it. But back in the 80s, the debt to GDP ratio of the US was dramatically lower, and currently we're at over 100% debt to GDP. Just the cost of servicing the debt that we have is astronomically higher than the 80s. The Fed doesn't have the same option to really keep increasing rates the way that they did in the 80s. I mean, I'd have to think, correct me if I'm wrong, Reed, but what did they get up to? Is it 20%, 30%?
22% or something like that.
22%.
Yeah.
Yeah,
Well,
they did that.
Volcker, right?
Yeah, Volcker. I mean, if they did that now, I mean, the amount of money spent on servicing the debt would completely bankrupt America. So, you know, the Fed is independent, but, you know, they're not independent enough to crash America. So anyway, getting back to your question, Christina, are they really done? We don't know. We think that they are. We think that they're probably going to be lowering rates over the next few years. That's what the Fed says. That's what the dot plot says. At the same time, I think Reed mentioned, we're still getting fixed rate debt to wait and see what happens because, you know, it's a tail risk, but it could go up and there could be continued high rates. It could be a problem. And it's something that we want to hedge against. But no, if I had to be a betting man and it was an even money bet, I'd say that rates are going to drop.
Yeah, I've actually heard some operators forego rate caps because they think it can't get any worse. So they're saying, screw it, I don't want to pay $1 million on a rate cap and I'll just, take the risk. So we're not that type of group, but I have heard in the circles that I run, I have heard some people doing that. So good on them. Craig Stevens, how are you, mate? Good to get you back on here. Another great partner of ours here at RSN. Could you chat a little bit more about how you see preferred equity opportunities coming up? So yeah, the preferred equity opportunities that we're seeing, and I'm actually involved in a deal with my former company that had this happen. So say you've got a deal where you've gone in with, and let's be honest, the belle of the ball for the last 3 or 4 years had been floating rate debt funds before we had COVID and before we had the run up in interest rates, right? It was, SOFR was it was at zero. I think you could buy a rate cap for $30,000. So, people have gone out and got leverage, right? 2 or 3 years later, they've come to get to their, do you want to go and apply for your extensions? Well, one of the deals that I was involved in, I'm not the direct operator, but they met the extension. I think they met the extension requirements, but they didn't. But the lender had collateralized the loan with a bunch of other office, and so they were like, "Give us the money back." And that was talking about earlier about liquidity crunches at the banks themselves or at the lenders themselves. Hence why we're constantly having conversations in real time with our lenders, like, guys, how you going? Anything we need to be worried about? So that's a side story, but it's an example of, well, then those guys had to go and pivot and say, well, what can we go get in terms of current lending? Well, the agencies are still lending, but they're only lending at like 50% leverage. Well, that's not going to be enough to pay off the existing loan, and the existing lender wants their money back. Well, what are you going to go do? Okay, we got to fill the gap between, say it's 50% coming with Freddie and Fannie. You got another 20% to fill. That was where you go and you'll put a pref equity in. Now, sometimes some operators will go and ask investors for that money or an opportunity to invest as that quote unquote pref, but 9 times out of 10, you need to act quickly. And thus there's pref lenders out there between, in the low double digits. And that's how they filled the capital stack. So Craig, I don't know if that answered your question, but that's called that's like a cash in refi or a cash pref refi. A cash in refi would be where, okay, you could go get an agency loan, but you may need 10 or 15% from investors to chip in. And you don't want to necessarily go and do that pref. So either option, you get the pref or you do a cash in refi with investors, and that's a capital call to pay off the existing debt and get a new debt term. And sometimes that might be better than losing the deal completely at a loss and going raising another 10, 15% of your equity rather than losing the deal and losing everyone's equity. So seen a few of the deals out there like that. This particular deal I'm talking about is going to be just fine. It's in a fantastic area. The operator's doing a great job. But that's how it would work for pref equity. With that being said, we are 1 minute before the top of the hour. We want to thank you all again for jumping on this webinar. We could talk for hours. I'm clearly can talk for a long period of time. Again, huge thank you to everyone who's joined. We are going to send out that investment survey. We would love to hear where you guys are at in what you're doing. Anything, just any feedback would be great. If you're actively investing, where you're actively investing. If you're not, if you're sitting on the sideline, that's fine as well. And just a quick reminder, we will have that new investment opportunity, the St. Marcus Build for Rent deal, up next Tuesday at 5 p.m. Pacific. If you're interested in that, you can reach out to us and register. Once again, thank you so much. Enjoy the rest of your evening. Ben, any last parting words?
No, that's it. Thanks for everyone for joining. If you have any follow-up questions, shoot us an email. Want to jump on a call? We're happy to talk. Thanks so much, everyone. Have a great rest of your evening.
Talk to you soon, guys. Bye.